Are you investing in the wrong dividend ETF? In today's video, we're going to be breaking down the Schwab US Dividend Equity ETF, or the SC. Now, this is 30% of my portfolio. This is an ETF that I have held for an incredible amount of time, and I want to break down the 13 little known benefits of the SCHD over other ETFs. Now, when you think about it, this doesn't get a lot of press unless it's doing poorly, and some of the videos we've seen lately have said, do we double down? Do we buy more of this SCHD? Is it really worth it? Or do we just opt out? Do we look for something else? And my opinion, not a financial advisor, would say, and I continue to buy more of the SCHD. So when you think about it, why do we buy this? It is a very nice blend of performance, cost effectiveness, and really that is what separates it from other ETFs. Very straightforward, cost effective way to invest into something compared again to other ETFs. And when it's a larger part of your portfolio, even when you start getting to those larger dollar figures, you're getting a very good return in the SCHD, which again is the reason why I hold it. So let's break this down a little bit further. So first of all, it focuses on dividend quality. That's right, we are not looking for the absolute highest dividend payers. A lot of times with companies that pay dividends, one, they need to pay dividends to attract investors, or two, they're a company that is looking to just bring a lot more money instead of putting it into their own company. Now, we see this traditionally with REITs. This ETF really has a big and longevity, good history of paying dividends on a consistent basis. Company must have 10 consecutive years of dividend payouts to be considered into the SCHD, making sure that really they're rewarding the shareholders, and we know the companies are going to be around for an extended amount of time. Now, it also does have a smart dividend growth strategy, just doesn't focus on the high yields that we're seeing today, but it is also focused on not only the company growth, but the dividend growth as well. That means they're going to get more benefit out of this rising income over time, meaning companies that are increasing their dividends as they have that 10 plus year track record is going to be adding the benefit for long-term investors. And when it comes to the SCHD, it has a very low cost effective, very low fee, a 0.06, guys. When it comes to ETFs, this is the reason why I only focus on ETFs. I do growth ETFs, I do dividend ETFs, I do, the foundational ETFs. It charges a lot less. Now, the average for an ETF like this is a 0.30, where this one in the SCHD is a 0.06, which means you get to keep more of your money. When they're paying dividends, you do get to keep more of that hard-earned money that you're earning from there. Now, of course, they also do have built-in quality screenings. So when you look at this and what they're putting in the SCHD, they are looking to a return on equity, the debt levels and cash flow that companies are keeping, making sure that they're not going to cut dividends, and they're not going to cut dividends because they have healthy balance sheets. It is something that I like. It is a financial analyst that is doing the work that you could do on your own, making it really a big difference. Now, of course, it does offer diversification without excessive risk. Now, there's about 100 companies that reside within the SCHD. You have diversification without diluting what you're investing in itself. When you look at it, spread one assets across 1,000 different stocks, you might own a fractional share of each company. We are keeping it really relatively positive and a good position in those companies by keeping the portfolio a little bit more diversified. And overall, it's not tech heavy. This is the big reason. A lot of tech companies, when you look at Apple, when you think of Microsoft, when you think of Amazon, they're really good for growth, but a lot of those companies don't pay dividends. When you think of an ETF like this, you are looking to get and really invested in sectors that have a strong traditional of paying dividends, focusing more on healthcare, financials, and leaning more heavily on SCHD. And of course, when you think of downturns, which they're estimating 2025 could be a down year for the market, when you start looking at a downturn in the market, dividend paying companies have volatility and have the chance to pay less dividends. However, during market downturns, the SCHD has actually performed very well. And also with the payouts we've seen a very strong and healthy growth aspect for the companies that are held within the SCHD. They do offer consistent quarterly payouts. Dividends are paid quarterly. I just got mine for December, which I was super happy. It gave me another couple $100, put it right back in my portfolio, buying more of the SCHD over and over and over again. It is a very predictable income stream that continues to increase as we see companies grow, as we see inflation growth. This could be your supplement to Social Security when you get to retirement. And if you keep it tax-wise, you could even have that capital gains tax that is not going to be or negligible or zero depending on where you're at. Now, reason for this, extremely useful for retirees or people that depend on those quarterly returns to really not only fulfill their investments if they're reinvesting it, but also the growth factor that is there. You want to make sure ETFs are paying on a very consistent basis and making sure that you're getting the money out of there. And of course, when we talk about it, tax efficiency. It's structured and the strategy makes the SCHD relatively tax efficient, very less turnover than other ETFs, and it focuses on companies that are consistently paying out dividends and also have a very strong foundation. And of course, it favors US companies. Now, for me personally, this is my personal preference when it comes to investing. I keep all of my investments in the US. When it comes to Trump, when it comes to Warren Buffett, when it comes to all of these really big investors, they have said investing in the US and investing on our shores is the best thing to do. Now, of course, I don't invest outside of the United States. That is my own personal preference. If it's held in an ETF, it's held in something like this, I'm completely okay with it. The thing is, I don't know foreign markets like I know our own markets. I don't know the foreign companies like I know the companies that are here. And when you start thinking of larger companies, again, getting back to Amazon, Nvidia, when you start looking at these larger companies, we are now really a global economy, meaning that all of these larger companies that really run and invest and operate in all of these different countries all around the world, it's not just tied to the shores of the United States. When you're investing in a company like Apple, you're investing in a global company that is in a multitude of countries around the world, meaning the diversification might not be there for the company itself, but with its global reach, not investing in their markets directly, you are still kind of directly investing in the markets or indirectly investing in those markets. Because when you think of Starbucks, when you think of companies that are global companies, Coca-Cola, they are invested in, depending on what the economy does in these other countries, really going to make a big difference on what your holding could be within the United States. Now, of course, with the SCHD, transparent and rules-based, very cool, very clear, very rule-based, really logical reason to choose stocks. Transparency allows you to know exactly why they've chosen a fund, what is staying in the fund, what is coming out of the fund. It is a very straightforward process. And of course, this ETF has been very reliable looking at historical performance. Now, of course, it doesn't, and it's not indicative to anything in the future, but overall, since 2011, it has had very solid returns for investors. That is why they have the SCHD and why they like to really carry it. And of course, with my 3 ETF portfolio, like I said earlier, this is 30% of the portfolio. When I started looking at comparison like a JEPI and the VYM and the SCHD and a lot of these dividend paying ETFs, I chose to go with the SCHD. And of course, really haven't had any problems with that because it auto rebalances. Now, it has been rebalanced to stay true to the investment strategy, making sure that companies don't fit in there or companies that do fit in there are going to be in this ETF in the entirety. Even when they restructured last year, it did work out incredibly well. So guys, that's going to do it for today's video. Definitely wanted to cover this with the little known benefits for the SCHD. Me personally, like I said, 30% of the portfolio does sit in the SCHD. It has done incredibly well with returns as well as the dividends that it's posted. So I'm pretty happy and I'm going to continue to carry it in my portfolio. So again, that's going to do it for today's video. Let me know what you guys think and I'll catch you in the next video.